Hello, my name's Mark Sturdy. I'm the owner of 7 Days Ahead, and I want to talk about our product, which is the multi-asset trade recommendations, which is specific trade and investment recommendations from the multi-asset space of currencies, stocks, bonds, and some commodities. These bulletins, these recommendations are issued whenever the opportunity arises to our subscribers. Let's have a look at one in particular. This is one that was issued on 25th of March this year. Quite simply, we start with a technical analysis of the situation, long and short. We believe in both long and short analyses insofar as we need to know all the forces at work on a market at any one time, so we need both the short and the very long to know that. So we have the rationale for the trade. Look from the weekly chart, the daily chart. On the daily chart, we show the stop where we want to have our stop put in. And then we look at the rationale from the fundamental point of view, and my colleague John Lewis writes this each time, explaining from a fundamentalist point of view why it makes sense, as well as the technical point of view. The idea is that we marry the best of technical recommendations with the best of fundamental recommendations to get a very good series of investment and trading opportunities. These, as I say, are published whenever the opportunities arise. We issue them during the day. Obviously, by the time they arrive in your inbox a few minutes later, the price might have moved, but it goes up as much as down frequently, and typically we are not that time sensitive, so it should work as much in your favor as against you. It should even itself out over time. The way we assess the success of our recommendations is to have created a notional trading fund, and we then we allow you, the subscriber, to choose the amount of that fund you wish to risk with any one trade. So, for example, we've been doing these recommendations since 2006, and on our website you'll be able to see this page which shows our success since 2006. So, for example, if you were trading with £100,000 and chose to risk just 2% of that on any one trade, you would have 277,000 odd now over the last 9 years. If you had chosen to risk, perhaps more realistically, 5% with each trade, we tend to have no more than 4 trades outstanding at any one time. Your capital would be worth, on fairly conservative assumptions, about 800,000, 800,000 or 900,000. So we believe we've got a reasonable track record here, and I think it's worth your while having a look at it and see if you can fit it in to your existing trading activities or investment activities. I would just say the whole point of this is to match the level of volatility of results to that which you're comfortable, so that if you are, obviously you can have the higher return, but you suffer the higher volatility. If you go for much lower levels of risk, like just risking just 1%, then of course you end up with much less volatility. I hope that's of interest. Do please get in touch if you want to discuss this further, any of the assumptions behind it. But we think they're realistic, and I think it gives a good insight into the sort of risks we run by running this these key trade program, by looking at it through the prism of a virtual hedge fund. Thanks very much.